in that environment, let's embark on Operation Twist. What is Operation Twist? In what he said in that press conference right there, you just said what? He said, we're going to do this. First of all, it's a continuation of a program they began last year. And that is they're going to sell short-term bonds, bonds with maturities within the next 3 years, and buy long-term bonds, bonds with maturities 6 to 10 years from now. Sell the short ones, buy the long ones. Why? Because they want to bring down the interest rate on long-term bonds. They want to bring down the price of those loans. They figure if you can create demand, if the Federal Reserve is buying these long-term bonds, if you create demand, then that reduces the price and the price on the interest of that money. And the goal there, by reducing the long-term interest rates on Treasury bonds, is that so many things in our economy are linked to the price of a Treasury bond. Home mortgages, corporate bonds. The benchmark for bonds is the United States Treasury. It's the safest investment in our country. And many other investments link themselves to that. So if you can reduce the price of a Treasury bond, you might reduce the price of other credit throughout our society and get people borrowing, investing, and spending.
That was such a great explanation. Really. I appreciate it. I don't know why it has to be that difficult.
Can I have some
Ben
fun
Bernanke.
with...
Let's go for it, because I think we want to cover two bases, by the way, Buck. You and I can probably have a monetary debate, and then we're going to have politics. We go.
As far as I see it, here's essentially what really is happening. Quantitative easing, that was the bazooka. Didn't work, or maybe you could say that if we didn't do it, the world would end, which is basically the argument the administration has made. This is the BB gun. I mean, this is not a big thing. This is very unlikely to have any real market-moving impact. And really what you're seeing is that the Fed is kind of out of options because interest rates are already basically at zero.
You are 100% right, in my estimation. This is like, although no one really knows, this is not likely to have a big effect. As I said, this program began last year. This is a continuation program, Operation Twist. And by some estimates, and again, nobody has an accurate algorithm for this stuff, but this lowered the Treasury rate by 0.15%. and lowered mortgage rates by less, and corporate bonds by even less.
So is it just something to do?
That's actually an excellent point. There is a theory out there that by the Fed just taking action, you give the market and investors confidence that if things get bad, the Fed will be there to back you up.
Right.
What's interesting here, though, is there is a trade-off. For every action, there is an equal and opposite reaction. It would be a good thing to remind, I think, some of the Fed chairmen at some point, that over the long term, when interest rates do go up, when employment is a little better, this could have long-term market distorting effects. People don't even really know necessarily what they are. So you're hoping for short-term gain here. But again, this is the Fed trying to manipulate the economy in a way that will make things look better now. You could say it's political, or you could say it's not, but that is definitely true. They're trying to give us a bump right here, but at some point in time, interest rates will go up. And when those interest rates go up and when employment is a little higher, you will see, you'll have to pay the piper. This will actually change the market down the road in a way that we can't necessarily see right now. And that's assuming everything works.
That is also 100% true.
Two for two.
And I think that Ben Bernanke is quite honest about that. You are trading long-term risk for short-term advantages. The idea is, yeah, we can't distort markets forever. Long-term, we can't play with the money supply and we can't distort bubbles and booms and busts throughout. But right now, it's different. The risks in the economy are so great. Ken Rogoff, an economist, wrote an entire book entitled, that was the title of his book, This Time is Different, that we are on the verge, a perpetual precipice of a depression. With Europe collapsing, a housing bust here, we're in a really tight spot. And this is what you do in the short term to avoid a depression. That's the argument.
I mean, the hope here, guys, is that... right. the hope here is that... I feel like we don't want to have this just be a one-way discussion. Is that most... hello. Most of what they're hoping will happen here is that homeowners essentially will refinance mortgages. That there will be... people that are making these economic decisions tend to make them on a longer-term basis, and that will actually get more capital flowing, really. It does still raise this issue of sort of long-term liquidity versus solvency for our national debt. You know, is this a good idea? But putting that aside, in the short term, they hope that this will get people to buy homes or refinance the homes that they already have. Part of the issue here, though, is that most of the people who can do that already have better credit. So this kind of a program can tend to save the save to some degree, because allowing people to refinance, you tend to get people refinancing who are already doing somewhat okay. This incentivizes the banks to maybe originate more loans for more people and thus get things going. But it doesn't necessarily help the people who are really in trouble, which is supposed to be what the whole target of the program is all about. And that's apart from a long-term cost.